This is a video in which I'm going to talk of the common trading myths, which are basically lies, which are things which some traders say or teach because they have the bad type of information that is circulated among most retail traders who are actually people who are not profitable. So these are things which you will have to be careful of, because some of them may be things which will discourage you from doing or achieving certain goals in your trading, because we use a profitable trading method here which has good performance and in which you will no longer be restricted by some of these common trading myths, because the one which we use actually is the best trading method in circulation in the retail sphere. So the first trading myth is that trading is hard. That some people say. Okay, you will see a lot of people on the internet saying trading is hard. And it's not necessarily that trading in itself is hard, but what makes it hard is that most mentors are scammers. Most of the people who bring people into trading are not profitable themselves and cannot show trade histories which show their profitability. So some of them now end up teaching trading methods where they tell people that you can just trade any trading method even if it has low performance, a low win rate, as long as you try to aim for high risk reward. But like I told you, the problem with that now is you have no guarantee of price reaching a high reward to risk if your low win rate is the trading that you have, because now you have small momentum in your favor. So you will have no guarantee of your trades always reaching that big take profit target. So that is one of the things that now makes trading hard in a way, because people will now try to end up spending a lot of time and effort trying to turn trading methods which are not profitable into being profitable. Okay, so in trading, you should just look for trading methods where you don't have a win rate of less than 50% and where you have a win rate of more than 50%, where you win significantly more trades than those which you lose. It will make things easier for you, and once you do that, trading no longer becomes hard. And then the second trading myth, which is also related to the first one, is that some people see a lot of people also saying trading is mostly psychology or risk management and less of the strategy being important. And that is also a lie, because just like I said earlier, trying to aim for a high reward to risk trade like 1:2 or even 3:1, 5:1, you have no guarantee that price can reach those targets if your trade is if your trade is momentum coming against you. If you are using trading methods which are unprofitable, where you are actually liquidity to the market makers, where they will be driving price usually in directions where your stop loss will be. So you will be liquidity to the institutions, the market makers, and there are actually less chances for price to be able to reach your high reward to risk target. And also you should note that also risk management, in that sense of trying to aim for high risk reward management, there are a lot of people, of traders out there, who are trying that. And if it was working, you would have actually heard that maybe even half of all the traders are profitable. Okay, but statistics say that most traders lose money. Maybe only about 30% are profitable. And then when it comes to day trading, where your trades last a day or less, even less are profitable, maybe about 5 to 10%. Okay, and if every trading strategy was profitable, if you would just aim for a big profit target, word would have already circulated in the trading sphere that that's all that you just have to do on social media. And a lot of traders would have had already been doing that. But you can actually see that it's not a case where almost half of the traders are profitable. So you actually need trading methods where you actually win more trades than you lose. And trading strategy is more important, or your trading method, because even if you use aggressive risk on your risk management, and even if you break a few of your trading rules, but if you have a high performance trading method, you will still be profitable. Actually, you might even end up being more profitable than someone who risks very small on their account, because it's hard for you to have like over 40 consecutive losing trades if you have a trading strategy with a good performance of about 70% win rate or more, and when you don't also overtrade that much. So the other next myth is that day trading and scalping are a scam or gambling. So remember, day trading, like I said, are trading where your trades last a day or less. And then scalping are trading when your trades last minutes or even seconds, up to usually about 3 hours. Then day trading will be now when your trades last about 3 hours up to about a day, and usually not um, being open up until the next day. Then the other forms of trading which take longer periods of time are like short-term trading, where your trades lasts more than a day up until about a few days or a week. Then swing trading is when your trades last about 2 weeks, more than a week up to about 2 weeks or even a month. Then position trading is when they last for about a few months or more. So some people you will see on the internet will say that day trading, any form of intraday trading meaning both day trading and scalping trades which occur within a day. You will see some of them saying it is a scam or gambling. And it's only because they do not know how to do day trading or scalping profitably, and their trading strategies maybe are not able to do it with a good performance. You can be profitable scalping if you trade within open sessions of the day, like those open sessions which I told you. And remember, open sessions are just times of the day when market makers send price usually in the same direction of the daily bias. The daily bias just being the direction where the price will move on the 1 hour time frame as a gradual direction and which will end up being the color usually which the daily candle will close at the end of the day, either being bearish, a red color, or being bullish, a green color. And what you can also do for you to have good results in day trading or scalping is to trade in the same direction also as both your daily bias and also your higher time frame trends, especially including the daily time frame trend. And you can use those bias methods which I gave you. You can check it within the content which I gave you, where for the financial instruments we have a big number of bias methods which I gave you, okay, like also the higher or lower method, New York higher or lower method, where you check if price at 8:30 a.m. New York time, if that price at that time will be higher or lower than beginning of the New York day, since there will be financial instruments. And remember that New York time, EST time, is 6 hours behind Zimbabwean time in March to November months. Then it is 7 hours behind Zimbabwean time in November to March months. And you can always check on the internet when those time zones change. Then for synthetic indices, for your bias methods, you can, especially for volatility indices and the step index, you can check for whether the price moves more higher or lower in the first open session of synthetic indices, which will be 2 to 7 a.m. GMT time. And remember that GMT time is 2 hours behind Zimbabwean time. And then also for day trading and scalping, for you to improve performance, you can also try to trade also in the same direction of the 4-hour time frame trend, it also being in the same direction of the daily time frame trend. And also you can even use all other market conditions I gave you which improve performance of your trading. I also actually will have a video on that on the YouTube channel of all those market conditions or confirmations which you can use to improve your trades. And then the next trading myth is that no profitable mentor sells courses or information on how to trade profitably. Usually people who say this are people who hate trading, who think that trading is a scam, and also even you will see also a fewer percentage of traders saying that. Okay, but you should remember that all profitable traders were taught by someone to trade. So you can't say that there is no mentor who's profitable who can teach people. No one can learn trading on their own. Even if you were to say that you learned on your own on the internet, there is no such thing as you learned trading on your own on the internet, because whatever video you are watching on the internet, whatever book you are reading, there is someone who made those trading materials, who most likely is advertising other paid courses that they have on their YouTube channel. And if it's a book, someone actually sold that book. Okay. And you should also remember that it's not every trader who makes very high returns like those which you will see scammers showing off on social media of like 100% interest a month or more. You should know that the best of most profitable traders can average about 8% interest per month. Okay, and some traders actually average about 5 to 6% interest per month. Those who are profitable will be able to show you annual trade histories of 12 months or more. So with such smaller percentages, if the mentor will be someone who has a small amount of capital, they might not be able to make a living from trading in itself. So some of them maybe now could do mentorships or sell signals so that they boost their trading capital. And you will also even see that later on, maybe when they will now be able to have a bigger amount of trading capital which they can live well off each month, maybe that's when some of them may now no longer now offer trading services. And there are even other examples of traders on the internet who show their trade histories, like Nifty NB, who teaches option trading. He has a trade history on his YouTube channel. Even also, there's another one called Andrea Monga. He actually once won one of the trading competitions. Okay, and then also there are also even other mentors. Even also this one, Mie Barak. I think he also has a trade history on his YouTube channel. And even also for me, I also have my own profitable trade histories on my YouTube channel there. And then another trade myth is where people say that you should only risk not more than 1 or 2% of your account per trade, otherwise you will not be consistently profitable. That is also a lie. You actually can be profitable, actually even risking even 5% of your account, or even if you are someone who takes less trades. Okay, you can, and if you have a big trading account, you could even risk about 10% of your account per trade. But if you have trading strategies which have high performance, where you win most of your trades, and then you can check in the video which I shall record of trading model risk management, where I show you a safe way where you can try to estimate the number of maximum consecutive losing trades that your trading strategy can give you, so that you can try to increase risk, where you risk now more than even 2% of your account per trade, and will not blow your account. Okay, even though it won't have 100% guarantee, but it's very likely that you will not blow your account, and you can even do it with just half of your total portfolio using such a trading method. And you should even also know that Larry Williams, who won a world trading competition in 1987, actually said in interviews later on that in the trading competition, where in a 12-month period he made 11,000% interest in a year, he actually was risking aggressively, risking about 5% to about 30% of his account on some of the trades. And he actually was profitable for a year, though the trading competitions will be done for periods of a year, maybe some of them periods of 6 months. And 1 year is actually a good measure of consistency for profitability. So you can see there in 1987 where he made 11,000, almost 300% interest on a year. And it's a trading competition regulated by the CFTC, by the Commodity Futures and Trading Commission, where they actually even audit the results of the traders after the trading competitions will be closed at the end of each year. And you should also note that if you have a good performance, even where you have like 70% win rate or more, there is no way in which you can have like 1,000 consecutive losing trades. Okay, so you actually can even risk more than 1% of your account per trade and still be consistently profitable. But you should then just know that you should now be prepared for bigger drawdowns, as your account might now go into bigger drawdowns, which are just your account losing money in terms of percentage wise compared to the balance that you started with initially. Okay, so you would then have to have stronger trade emotions if you are going to be risking more than 1 to 2% of your account per trade. Then the next trading myth is that SMC is a scam. SMC is a trading method which tries to show how institutions may be moving markets with their orders, and also sometimes it may also in some versions show how institutions also try to drive price against the trading methods used by most retail traders, which will be unprofitable trading methods. So SMC or smart money concept is actually a profitable trading method, although the trading method that we use is actually better than SMC. And the problem with SMC is that you won't be trading usually within open sessions, and you also won't be including daily bias, although you will be able still to trade with order block strategies. And then also what makes SMC less effective than our trading method is that your trades will also have a smaller reward to risk. So you will have less profits. And SMC also has less of a guarantee of longevity for its strategy, meaning that you might not be able to be profitable for a few years or more, sometimes depending on how you use it. Although you could be profitable for about a year or even a few years. But if you do add maybe 4 hour time frame trend to trading also in the same direction of both 4 hour time frame trend and daily time frame trend, you might be able to have better reward to risk, and you could now end up having more longevity on your trading. Okay, so be also careful of people on the internet who you hear saying that SMC is not profitable. There are actually people who do make money with it, especially if you trade in market conditions which are highly favorable for you. Then the next one is swing trading is more profitable than intraday trading. Okay, so swing trading, remember, is where trades last longer and people can trade maybe on higher time frames like the 4 hour time frame or the daily time frame. And the trades can last more than a week up to about 2 weeks or even a month. And intraday trading for beginners, remember I said these are trades which occur within a day. So also some people trade swing trading and say that intraday trading cannot be consistently profitable. But that is also a lie, because they just do not know how to trade intraday. And they do not know that within each day, there are certain times of the market that the market will move price in the same direction of bias, and certain times that the market will move price opposite the daily bias direction. And those are regions which are called protractions. So for example, for your synthetic index asset classes where we trade them on derivative, especially for volatility indices and the step index, open sessions, the first one is 2 to 7 a.m. GMT, where price is moved generally in the momentum of same direction of the daily bias. And then its second open session will be 10 to 1 p.m. GMT. And then third open session will be 5 p.m. to 8 p.m. GMT. And then times of protractions where price might move in a momentum which is more against of the daily bias will now be in between those three open sessions, where now price will be taking liquidity of going above highs which occurred in the open sessions on a bearish day. And then in opposite case scenario, if it was a bullish day, price sometimes will now tend to go below lows which all formed within the open sessions. So those times for protractions, sometimes in synthetic indices, especially the volatility indices and the step index, will now be in between those three open sessions, which can now be 7 to 10 a.m. GMT and 1 p.m. to 5 p.m. GMT. Then remember, for financial instruments, the real markets where we trade things like forex, currencies like bonds, stocks, or even stock indices, they now, our open sessions will now be in USA New York time, where the first one, the London Open, is 2 to 5 a.m. New York time, not 2 to 7 a.m. like the first open session in synthetics. But now in financial instruments, first open session will be 2 to 5 a.m. New York time, USA time now. No longer GMT time of synthetic indices. Then the second open session will be 8:30 to 11 a.m. New York time. The second open session for financial instruments, it's called the New York Open Session. Then the New York Q Zone, which is slightly before the New York Open Session, which also moves sometimes in the same direction of daily bias, will now be 7 to 9 a.m. New York time. Although in one asset class, I'm not sure if it's forex or in stock indices, it sometimes can tend to move against the direction of daily bias. I'll check for you. Then for stocks, only for stocks and for stock indices, you can then now trade also in the afternoon session, which is now 1:30 p.m. to 4 p.m. EST New York time. It also usually moves price in the same direction as of daily bias. Then for protractions, a stronger protraction for financial instruments, which has been observed for many years, is from in between the New York Open, which is more like second open session, and in between the afternoon trend, which is more like the third open session. So that will now be 11 a.m. to 1:30 a.m. New York time. Price will move now in the opposite direction of the daily bias, and if it will be a bullish day, it will now go below to take out the lows of the morning sessions, to go below them. Okay, so if you use the open session concept, the time and price concept, and also the daily bias, you will now have profitable intraday trading. And because some traders do not know this, this is the reason why they end up thinking that swing trading is more. These are the reasons, some of the reasons why they think that swing trading is more profitable than day trading. But sometimes, when they tried scalping in intraday trading, they ended up trading in protractions on some of their trades, especially if their back tests had only a small number of trades, like maybe only 10 trades, since some of the traders will be lazy. Their back tests now maybe were biased because some of the profitable trades would have had luck of being in open sessions, and then when now they will be trading now going forward, the trades now would now end up being in protractions and now making losses. And then, even if you want to see more evidence of day trading having the capacity of being more profitable than swing trading, you can even just see that with the rate of returns that some traders make in the trading competitions, like the ones I showed you. There were some traders, even in a year, who do intraday trading can even make about 500% interest in a year, or even more. Some, like for this year, currently this one is 495%, almost 500% interest. Though the trading challenge will end in December, but it's almost over. But in other years, besides the Larry Williams record, which I showed you of 11,000% interest in 1987, there are also even other traders who would have returns like this of even like about 1,100% interest in a year. And you can be more profitable doing intraday trading as long as you know what you are doing, because remember, it gives you more trades, so you will have more opportunities of having more transactions. And as long as you are profitable with compound interest, you will now end up having more profits. Whereas you will only be able to open one swing trade maybe in a month. That is if there would have even been a setup. Sometimes it even takes a few months or even a number of months for you to be able to get a setup for swing trading. But with day trading or scalping, you would have already had many trades by then. Then another trading myth is that trading is very risky. So you will see some people, especially those who hate trading, who don't trade, or saying that trading is very risky on the internet, or even including a smaller percentage of some traders. But trading is not necessarily very risky. The problem is that most mentors are scammers. This is why you should only learn from mentors who show trade history which are profitable, like what I told you in that video for trading scam. Preferably, it has to be a trade history with at least 12 months or more, which is a good measure of consistency. Trading is not very risky in itself because, unlike other businesses, you have the option of backtesting even before you start trading with real money. So you'll be able to scroll in the charts even for a few years going back, seeing the performance of a trading strategy on a particular industry. Even after backtesting in history, you can then also have the option of trading going forward on your demo account, where you are not even trading with real money, but just with practice money, which is virtual money. So that in a way actually even makes trading a safe business. Also with the fact that even when looking for a mentor, it's easy for you to look for someone who you can see proof of the profitability with trading skills. In other businesses, when looking for mentors, you might actually not be able to easily see or easily evaluate the profitable of someone, of a coach or a mentor who will be claiming to be profitable. And remember also in trading, if you are afraid of risk, you can also choose to trade trades of high reward to risk, where you can be risking even 2 times, not risking, but where you can be aiming for a profit which is even 2 times or 3 times bigger than your risk or your stop loss. And then the next trading myth is that you can't be consistently profitable trading with high leverage. So also a lot of people saying this will be people who don't trade, who hate trading. And also you will see also some traders saying this, but that is also mostly a lie. Because if you open your account with higher leverage, when price moves a certain distance, okay, the number of the amount of money that you lose or gain from the account if you open a random trade on a demo account, it will be determined by the leverage of your trading account. So it does not necessarily matter how much leverage you are using, because you can still try to risk only 1 to 2% of your trading account, even if you have trading settings of high leverage on that account. When opening the account, you will just end up maybe needing a bigger capital size, but you can still risk even a small percentage of your account, even if you are using 1:500 or 1:2000 leverage, the 2000 which we use in Deriv. All you have to do, you can use the method which I showed you in the group, and I shall also make a video of that, where you just open a random trade on your demo account, see the distance, which are points, which price moved, look at the amount of money which price moved with, and then divide that distance or points which price moved with into the stop loss of your trade. And then the number of times it fits into there is that number which you multiply with the price, no, not the price, but which you multiply with the amount of either profit or loss which the random trade you opened and closed had made on the demo account. But I already have a video on the YouTube channel, I think, showing that. And I shall make another one of risk management, which will even show another example of that. And then another trading myth is that indicators don't work. So even though most indicators do not work and show only past price data, one indicator which I showed you, which even though it shows past price data, it is effective in trying to track institutional order flow of market makers. The combinations of the period 9 and period 18 exponential moving averages for daily and 4-hour time frame trends. And then if you don't want to use that one, you can also use a combination of the period 10 or period 20 exponential moving average crossovers, also for the daily and also the 4-hour time frame trends. Then also, when now looking for trend on higher time frames of the weekly or monthly time frame, you could then use the period 18 and period 40 exponential moving averages. They also try to track institutional order flow of market makers closely, and I've actually seen in my backtest results that they actually improved performance of my trading. Besides those, all other indicators will usually give you problems. And then another trading myth is that you can't trade on time frames smaller or lower than the 5-minute time frame. And even though there is more noise on those lower time frames, meaning that even though trading methods may not respond well, you actually still can be profitable if you use the trading method that we, since it's a strong trading method in terms of performance, and also since we will be trading during open session times and also in same direction of daily bias. You could also then add even other market conditions which improve performance of trading, like the one which are in the video which I shall upload of other market conditions to improve your trading, and you could end up even now trading on very small time frame. There are people using our same trading method, like including the strategies in my VIP group, can also trade even on down on the 1-minute time frame and consistently profitable. And even some of the signals I was sending you are trades which I even trade even on the 2-minute time frame. Then another trading myth is that binary option trading is a scam. You also see that being said a lot with traders and even people who don't trade. Although binary option trading is more complicated because price will have to be in your favored direction by the time of end of your trade, they are profitable trading strategies which you can trade them with. Like the trading strategy which I gave you of predicting bias of the daily candle, the weekly candle, or the monthly time frame candle, using methods of predicting bias of the candle which I gave you. And especially if you now either use an extra confirmation of trading after a swing on the time frame you are predicting the bias, or opening the trade at the time which the candle usually forms the opposite end of the candle, which can be the high of the candle on a bearish candle or a sell trade, or in opposite case scenario of a buy trade will be the price level usually formed when at a time usually when price forms the low of the candle. Then for day trades where you are predicting bias of the daily candle, another optional third confirmation you can use to add longevity and long-term consistency to your strategy besides the daily bias will also be opening your trades above the Asian range high or Asian Q zone high on sell trades, or the Asian Q zone high equivalent to synthetic indices, which will still just be the same time of 8 p.m. to midnight time of a day, trading up, opening the trade above the highest high that price formed within that 4-hour period. And then for buy trades, it will just be this opposite, where you will now open trades below the Asian Q zone, low in financial instruments, or its equivalent in synthetic indices, which now in synthetic indices will now be 8 p.m. to midnight GMT, whereas in financial instruments it was 8 p.m. to midnight New York time, EST. And you can actually even see with the trade histories that I showed you on my YouTube channel, where I actually also was profitable with that binary options strategy for the daily range version. And even in the world trading competitions, they actually were some years back where they actually also were hosting competitions for binary options. But I think they later on stopped them after binary options were now illegal in USA. But if you scroll, on this section, you can see the type of competition it will be. There actually is someone who I saw who entered for the binary option trading, who actually was profitable on a 12-month period. Okay, or maybe it wasn't a 12-month period, could have been a month, but you can then check later on if there are other people who have for 12 months. But you can obviously even see my trade histories have performance which is also of not just 1 month. And then another trading myth is that new traders should learn to trade only with real accounts instead of demo. There are some traders who are teaching this, saying that trading on a demo account for a beginner will not teach them to be resilient of negative trading emotions and will not train them enough to be used to losing money. But that is actually bad trading advice, because if you make losses early in your trading career, it will actually give you scars of emotions which will always make you afraid to some extent when trading in the future. And even if you now will look at it, learning to trade in the beginning with a real account is a problem, because you will be making mistakes when learning to open trade. When you won't know what lot sizes are reasonable to use for the particular instrument you will be trading, you could end up even with blowing account. Even if such mentors will tell you that you can learn to trade with money you can afford to lose, you still should learn to trade first on a demo account for at least a month or more. But even if you want for longer term consistency, if they are your own trading strategies that you made on your own, if they are not the ones which I gave you, you could then even trade for longer on a demo account, preferably for a year. But even if you are impatient, even for about 6 months. But even besides demo trading, if you are in a hurry, even by just backtesting and scrolling back in the charts, if you backtest well, you will be able to see if your trading method is profitable. But teaching people to trade with real accounts for beginners definitely is not a good idea. Even in all other industries besides trading and other businesses, it's an advantage if people learn to do something by practicing without actually wasting resources or money. Even pilots, even astronauts, they practice in simulation trading environments before they actually start flying a plane with passengers. So it does not make any sense for you to start learning to trade with a real account. And then another trading myth is that every trading strategy is profitable. Like I was said earlier on the point for trading is mostly psychology, where some people will be saying that you can even be profitable by trading a trading method where you lose most of your trades, having a low success rate, as long as you aim for a high reward to risk, aiming for a high profit target. And remember that I told you that the problem with that is that because of the low momentum in your favor, where you actually have more momentum against your trade, you have no guarantee of having your price reaching your take profit target. Okay, so that actually doesn't make sense, because remember, if every trading strategy was profitable, a lot of traders would have been making money. But remember, in trading, most traders lose money. And if it was as easy as just aiming for a high profit target compared to the risk of the stop loss, remember, word would have already spread in the trading industry on social media, and a lot of people would have been profitable, even at least half of the traders. And even if aiming for high reward to risk can make you profitable for even a few months or a few weeks, if you have low win rate, you will end up having a problem of achieving long-term consistency, a good measure of consistency, where you can be profitable for at least a year or more. And then the next one is you can't be profitable using trading signals or account management. And some people say this because it is hard to find a profitable mentor who can show trade histories, but they are profitable mentors. Even though it's very rare to see a mentor who can show an annual trade history or of more than 12 months. As long as the mentor is profitable and he does not risk too much, which you can see in their trade histories, they will not blow your account in account management. And you can even tell risk per trade if you like less. And for the signals, if as long as they are just profitable and they are good in giving signal instructions, you can actually be profitable in using signal. Some people will say it's impossible because they just have not yet bumped into a trading mentor or signal provider who actually is consistently profitable. There are actually people, some people who are actually have done account management for, and they actually withdrew money and were pleased with the results. So it's not impossible to have those good trading services. Then the next one is where retail traders, most of them, or a lot of them at least, think that price moves because of supply and demand. So price does not move mainly in trading because of supply and demand. And for intraday trading, actually it actually moves because of the algorithm, which is made by the market makers. And that is why our trading strategies actually have good performance, because we know what the algorithms do most of the times. And even for swing trading and short-term trading, it's algorithmic trading, although you now may be affected more with fundamentals, but your trading will still be mostly influenced by the IBDA uh, price algorithms. And price is not affected with supply and demand, mostly, because remember, if it was affected with supply and demand that much, market makers would have no guarantee of them making money. For market makers to make money, they have to design price to move in such a way which is against what most retail traders are taught. Otherwise, trading would no longer be a profitable business for them, and they would have never even continued to have the market open for us to trade. And if price was actually moving because of supply and demand, the market could end up moving price so high to the point where if everyone kept buying, or if everyone kept selling, or if more traders kept buying or selling, it could continuously move price in one direction, and every trader could end up trading within that same direction and be profitable many times, which would also now end up making the market makers to lose a lot of money. And it will trading no longer be a profitable, more of a casino for them. So supply and demand, remember, is one of the trading methods which are not profitable, which I listed in that video of trading scams, which is also on the YouTube channel. And price, so you actually know why it moves. It usually moves for rebalancing imbalances made by price delivery, and also to seek liquidity. Liquidity, by definition of stop loss of things which most traders are taught, even including the institutional traders, who also use some of those unprofitable trading methods like support resistance on lower time frames, or supply and demand, and other trading methods I also listed in that video of trading scams on the channel. You can see. And then the next one is that you can't be profitable trading synthetic indices. That some people actually believe that synthetic indices are a scam because they do not know how the markets move. And synthetic indices can actually be traded profitable. You actually also even saw my trade histories on my YouTube channel with profitable trade histories. And you can also even backtest some of the strategies which I gave you for free for synthetic indices, where you will even see scrolling in your charts in the past that they are profitable. The same market makers who made financial instruments are the ones who also made the synthetic index markets of Deriv Broker. So the trading methods also respond on both markets, but the times with which markets make certain movements will now be different. And then also the trading methods may also respond more differently, but you will still be able to find instruments which you can trade profitably. And you can see more of how the synthetic indices move in the book which I gave you for synthetic indices, which I wrote, where it shows the open sessions, how to predict weekly bias or even daily bias when trading derivatives synthetic indices. Then the next trading myth is that some people, okay, including those who don't trade and trade, say that you need about 3 to 5 years to be profitable in trading, or even about 2 to 5 to 3 years even to just learn trading. And that does not apply for all trading methods. There are trading methods where you can actually learn to trade even in a few months, even in a less than a year. I can actually even teach someone to be trading even within a month for CFDs or futures, or even within a week for binary options. There are even some people who even teach people to trade out there even in about 2 weeks, even if they are just teaching them smart money concepts. Although you should be careful that some of the people who are not good mentors will forget to teach other basic trading concepts like risk management, margin. So you would also have to have your own additional research besides that. But you definitely can learn to trade and even be profitable in way less than 3 to 5 years. One of the reasons why some people end up taking about 2 to 3 years to be consistently profitable is that we were introduced into trading with scammers, with people who were not profitable. So it ended up taking us time to find profitable trading mentors. But otherwise, when you do find a profitable trading method, some of them would take even less than a year, or definitely less than 2 or 3 years. And then the next myth is that you can't trade against higher time frame trend. So remember, I explained earlier that in intraday trading, where you are trading scalp trades which last seconds, even up to about 3 hours, you can even trade in protractions against the direction of the daily time frame trend. And remember, the protractions are times like, for example, half 11 a.m. to 1:30 a.m. in stock indices and stock markets. And you can see all the other times of protractions and open sessions earlier in the video when I mentioned them, or even in the other video which I shall record for you for um, um, uh, market profiles of the day. And you should also note that there are some people who actually even trade against the higher time frame trend. Although what I do when trading against the higher time frame trend is that I first of all look for the higher time frame trend, and then look for a day with a higher I will look for a day with daily bias in the same direction of higher time frame trend. But then I'll now trade within the times of protraction, where the algorithms now usually move price in momentum which are against the direction of the higher time frame trend. So me choosing the higher time frame trend and daily bias would have given me a higher accuracy of knowing the daily bias and daily time frame trend. But then I will now trade against the higher time frame trend and the daily bias. And then for the next one is that the forex market is recession proof. So remember, forex asset class for beginners is the one for trading currency pairs like your GBP versus USD, or it's Great British Pound versus US dollar. Some people on the internet, you will hear them saying that it's recession proof, meaning that if they are to bad events in the world events like maybe wars or other things, people could still trade the forex market. But although the forex market will still be open in such events or even in pandemics, performance of your trading will be bad. Because remember, for our real markets in the financial instruments, in the financial instruments like the stock, bonds, currencies, metals, price on very high time frames moves because of institutions, large institutions trade against the banks, the central bank. So when there will be recessions like pandemics or even wars or other things like that, which are produce fear in the market, those large institutions will now pull out their money and no longer trade. So that lack of volume in the market can now affect us even on the lower time frame, and price will not really move much. That we may now have bad performance within our trade. So though to some extent the forex market is recession proof in that the market will still be open, you still will not want to trade in such trading conditions because your performance now of trading will be worse. And for the wars, remember it will be wars of maybe like world wars, wars of countries with the major economies, the most powerful economies of the world. But if they are smaller countries which are not the major economies of the world, like the Russia-Ukraine war, it does affect the market to a certain extent, but where you can still trade and where if you backtest the same market conditions, you can just trade the same market conditions. Or if you had backtested the market condition without it, you could then just trade in more market conditions which are favorable in your trading by just adding maybe like one market condition, like just adding even 4-hour time frame trend to trade in its same direction as the daily time frame trend, when maybe your backtest responded only needing the daily time frame trend. That is, if you would have backtested maybe before the Russia-Ukraine war had begun. But for wars which may involve US and other major economies, you would need to stop trading. And then the next one is that you need large trading capitals of 5 to 25,000 US dollars for you to start day trading, or even larger amounts for swing trading. And you can actually trade even with less money than 5 to 10,000 US dollars. Okay, I actually even started trading with 66 US dollars. And remember, there are brokers who have micro accounts where they will have micro lot instruments which you will be trading. So you can trade those even starting with a 10 US dollar account, even risking about 2 to 4% of your account per trade for financial instruments. Then for synthetic indices, there are some synthetic indices like V75 ones or V10 ones or others where you can trade even with a $20 account. Okay, risking even about 5% of your account or even up to about 2% of your account. Although trading smaller amounts of money obviously will need longer periods of time for you to build your account to grow. And you might also, if you are trading with smaller amounts, to use the trading model which I taught you, where you can study the maximum consecutive losing trades that your strategy can produce with the average number of trades that you do and the average performance win rate that you have. You can then have an estimation for you to be able to prepare for bigger number of that maximum consecutive losing trades, even at least about 4 to about 8 times more, or maybe about 4 times to even about, yes, to even about 8 times more that for other accounts. For those accounts which you can trade about 8 times more than that, it can be maybe half of your total portfolio. And then on half of that portfolio, if you want 10% of the half of that portfolio, you can then even trade more aggressively to be about 4 times more of your what you would have seen to be your maximum consecutive losing trades which you saw in your back test. And it's actually rare for you to have drawdowns which are bigger than the number of trades which I have suggested there, which will be more than the maximum consecutive losing trades which you had back to back in your price history. But I will have another video where I explain in further detail how you can have a safer trading model for you to trade more than 1 to 2% risk of your account per trade. And even if you ask in other social media forums and other social media groups like on Reddit, you will actually even see, if you ask on some of the groups, there are actually a lot of other people who have started trading with less than 5,000 or 25,000 US dollars. Although most of them, some of them on social media, won't have proof of consistent profitability. Then the next one is you should only trade with money you can afford to lose. Some people suggest this, although it's not necessarily true that you have to do this. Some of the people who suggest people to only trade with money they can afford to lose are people who don't trade, who don't know that you can look for profitable trading methods, and they think that trading is gambling, and they also do not know that we have methods to reduce risk in trading, like I explained earlier, of the demo trading accounts and the back testing. And also even some traders suggest this, but they only suggest this because they have not met trading mentors who are consistently profitable, and they have not seen a trading method which is profitable. If you do have a trading method which is profitable, where you win in terms of win rate more times than you lose, significantly more times than you lose, so you cover for the spreads and also the other trading costs like commissions, you can even trade more money than that you can afford to lose. But you definitely should have back tested for at least a year or more, with your back test also including at least 20 trades or more, and also including the trading concepts that we use, like time and price of the open sessions or market protractions, daily time frame trend, or even other trading concepts within these strategies that I gave you. Remember that there are people who actually trade for a living, okay? And also remember that banks also trade forex with money that we sometimes deposit in the banks. Remember, they use some of the money to do their own investments, and one of them which they use forex trading, even for speculative reasons. So if you are still a beginner, you can actually just type bank trades forex, and you can even see later on and do reading if you want, and you will see that there are large institutions and banks, even like Dutch Bank, Goldman Sachs, JP Morgan, which actually trades millions and millions of dollars. Some may be even in the billions. And remember, there are also hedge funds which also trade forex. So it's not only money which people can afford to lose that people actually trade if you do know what you are doing in trading. The reason why even some regulatory authorities were ending up suggesting people to only trade with money that they can afford to lose is that there are many scammers in the trading industry. So they were just now giving this advice because new traders, some of them would not know how to really know legit trade histories which can be shown with mentors, and some of them would not also be able to find trading methods which have longevity and are consistently profitable. Then the other one is that you will see that on the internet it may be said that trading markets are not manipulated and that they are free moving markets. And that is also a lie. If they were free moving markets, remember I told you earlier that market makers will no longer have a guarantee of being able to be profitable. So they did make an algorithm which moves price usually in the opposite direction of what most trading mentors teach. And the markets are controlled, especially when trading, and they become even more controlled with less fundamentals affecting them when you are now doing intraday trading, which is why our trading, since it's more of looking for movements which the algorithm does, we now end up having a high performance in our trading where we trade intraday. And remember, if the trading markets were not manipulated, price could end up continuing to go high on some markets, like in cryptocurrency markets, since most cryptocurrency enthusiasts will want Bitcoin to always be rising. And if price continues to always rise, even if Bitcoin went to $1 million, where would the value be coming from? When specifically for Bitcoin, unlike our trading markets like Forex and stocks, remember Bitcoin also even has a further problem of it being a Ponzi scheme. So if people would now want to withdraw Bitcoin at $1 million value per Bitcoin, where would now the money be coming from? It will now end up being a problem. But even for us now, our trading markets, where it's not necessarily a Ponzi scheme, it will still continue to create a problem, because if price continues to just go up for a long time, very long time, or if it continues to go down with traders selling for a very long time, there will still be a problem, or that some traders will now take advantage of those very long trends and just opening trades and still being profitable even after a few months, even if they entered at a bad entry point. Okay, so the other last now trading myth is that the markets are ever or constantly changing. So people who usually say this are some people who don't trade, who hate trading, or traders who use those trading methods which I told you, where they have low performance, where they lose most of the times in terms of win rate, and they will be told to aim for bigger profits per trade than the amount they risk on each trade, which is just aiming for higher risk reward. And because they will have momentum of price coming against their direction of trade, there may be times in periods where they may have profitability, sometimes even for a few weeks or a few months, but in the long run, they may have difficulties in being profitable for a year or more. So this is why some of them will now end up saying that the markets are ever or constantly changing. But the algorithms of price have always been moving the same generally as they had been moving of the past. Maybe there may be just very small changes which may affect your take profit and stop loss because of very large time frame fundamentals which can affect price to some extent. Like for example, maybe in the time of the COVID pandemic era, price may have also been affected slightly there, or also, like I said, to a very minute extent, where the Russia Ukraine war started from then up until now. There may be a very small, slight difference, maybe in your take profit or stop loss levels, and maybe also in times where there were market crashes, like in the stock market crash periods. After that period, investors may pull out money out of the stock market out of fear, so there could be slightly less volume and maybe slightly less take profit levels will be achieved those days. But generally, the markets have always been moving the same. And anyone who you see saying the markets are ever or constantly changing is only saying that because they really do not know how the markets move. But if you choose a trading method where your strategies have performance where you win significantly more times than you lose in terms of win rate, you will not be affected that much in terms of markets changing. And even if they were to change slightly, maybe because of higher time frame events, fundamentals like geopolitical events or other world events, that is where you will now have the advantage of having to trade with sentiment. Remember, like I said in the other video, sentiment is you just trade in market environments which are slightly better than those which were profitable in your practice. And I also even told you the different types of sentiments you can use in that other